Okay, so a question I get a lot of times when it comes to real estate is capital gains. Like, what are the impacts of capital gains? Which I think this question's funny because capital gains for long term is less than what your income taxes are. So it's like, yeah, you just made $200,000 when you sold this house. You're going to pay taxes, but it's still a lot less than income tax. Yeah. But what does that look like? So I know you have to live in it for at least 2 years as a primary to avoid capital gains when you sell. But what if I live in it for 2 years and then I rent it out?
Sure, that's a good question. So the Section 121 exclusion that you're talking about is if you occupy a house as your primary residence for 2 out of the last 5 years, you can exclude up to $250,000 of gain on a single filing return, $500,000 on a married filing joint return. If the gain exceeds that portion of the gain is taxable, but that's the built-in gain exclusion. You can occupy it as your primary residence for 2 years, rent it out for 3 years, but as soon as that passes the 5